So, why Ethereum now, apart from the charts, is the merge. The merge is probably the single most important thing that I can think of that I've seen in crypto since the invention of stablecoins and the launch of ETH itself. Now, that's quite a big statement, and there are risks that it doesn't work fully. I get that. I'm prepared to take the risk because I think it will. You may not be prepared to take the risk, and that's fine too. So let's talk about the merge. So first we need to go back in time a little bit. We go back in time to the burn. So this is the EIP 1559, and what that did was change the dynamics of ETH that burnt using network activity that burnt ETH. Now, it reduced the supply of ETH by about 65%, and in a strong demand environment, supply reductions are important. They're not in most other times, but really when demand meets reduced supply, then things get interesting. So ETH massively outperformed Bitcoin because of this activity, because the ETH network is being used for DeFi, NFTs, all sorts of stuff. And with reduced supply, the price went up faster. That kind of makes total sense to me. But the merge is something much bigger overall. The merge is where Ethereum goes to proof of stake as opposed to proof of work. So now you're not having computers crunching the maths and being rewarded as miners for doing the work. What you're doing is you're pledging your Ethereum for a year to secure the network. And that's called staking. And staking participates by you getting a yield for doing that, which is staking your coins, i.e. you can't use them, and you get a return. So I'll come on to that in a sec. But what's really interesting here is this is a supply reduction of really monumental proportions that's about to happen. Now, I'm more of a demand side person than a supply side person, but when demand and supply are both in shock, okay, then we got something interesting. So what's the supply side? Well, miners. There are no miners anymore. So therefore, all of the activity of miners of selling the tokens that they've earned, they probably sell about to fund their own activities. That's about $1 billion or $2 billion a month that's out of the market. So that's a small supply shock. There's no ongoing pressure every day from miners who've been rewarded with Ethereum. So that goes, okay. Then the staking activity, there's currently about 9% of all Ethereum staked. By most guesses, that number should rise to about 30% because initially we should see some outsized yields, maybe up to as high as hell knows. But either way, it's going to attract a lot of capital into staking. And so that becomes very interesting itself, because if it gets up to 30% of all ETH staked, that's 30% that is dormant. That's 30% cannot be used for DeFi, CeFi, rehypothecation, shorting, liquidity provision, nothing. It's out of the system. Then, on top of it, ETH staking gets its yields from network activity. So as the network is active, it generates the yield. Add that to the burning for the network activity as well, and what you get is actually something that looks like it's going to be deflationary, i.e. there's going to be less ETH every day than there was the previous day. So that itself is really interesting. So as opposed to be a daily sell pressure of excess ETH in the market, it becomes a daily buy pressure. Now this might sound familiar to you because this is very similar to buybacks and dividends. So buybacks and dividends are very predominant in the US. It's one of the key reasons why the US markets have outperformed other markets. There are dividends, not mainly in tech stocks, but other stocks there's a lot of dividends, but buybacks are very big because of the tax breaks. So if you keep reducing the supply of equities by buying them back, you generate demand and reduce supply. So then in normal economic times, you find that the markets, because there's less equities around, because the market cap, there's this supply and demand dynamic of buybacks plus dividends. And you can see that the impact on price from this chart now, it shows that they're very correlated because it is just a nice dynamic that helps price performance over time. So we've got that. So this is the supply starting to move into demand, but there is a demand shock coming. One is the macro cycle. The macro cycle is turning, so therefore demand is going to come back as liquidity comes back. Secondly, ESG. Now, whether you agree with ESG narratives or not, it's real and there are mandates built on it, particularly in Europe, but increasingly in the US. Bitcoin is deemed by people to be less green. We know that narrative is a false narrative, but that is what institutions kind of believe, and they struggle to get it past their boards and their investment committees because of it. But Ethereum will be much greener. In fact, it's 99% less energy use than Bitcoin once it moves to proof of stake. So that removes that barrier, and that's a big stumbling block for institutional adoption. But there's something more important. Ethereum is going to have a yield of 4 to 6%. That's the best guesses. So now we've got the internet bond. Ethereum being the largest yielding asset in the space, it has in ETH terms, a risk-free yield because it's generated by a smart contract. So it pays out yield in the smart contract. Now, the risk you're taking is currency risk, pretty much a guaranteed yield from ETH. Obviously, there are things that go wrong. US bonds are deemed risk-free, but they're not. Nothing is in the world. But you know what I mean? This is a benchmark yield for Web3 from the largest asset in Web3, because Bitcoin doesn't have a yield in the same way, and it's not really used in Web3. So you want to allocate to this space, you are going to allocate to the ESG compliant yielding asset. That is without question. Also, it's easy to say because it's not to do with money, replacing of money, it's technology. This becomes like a technology stock with buybacks and dividends, which is bloody rare. And it's the fastest growing technology in the world. So this yield changes institutional adoption dramatically. It makes it so much easier to hold on balance sheets. One of the reasons why gold was not adopted by many institutions is because it doesn't yield anything. But this does, and the yield is decent. It's more than US treasuries, as it should be. So, okay, now we've got something interesting for institutions, family offices, long-term investors. But more than that, it creates a whole different set of outcomes. And that is the real build out of DeFi. DeFi and CeFi in ways that we can't yet understand. Firstly, to have a benchmark rate allows all other risks to be priced against it. So one of the issues with what happened with the recent blowups in CeFi is you don't know how to price risk. You know, what is a 20% yield? What is a 10% yield versus what? How much risk am I taking? Well, in traditional bond markets and credit markets, it's all price versus treasuries. So it's either LIBOR plus, which is for the short-term rates, or it's LIBOR plus 200 basis points, or it's 10-year yields plus. So it's all dealt with as spreads. Even Italian government bonds are spreads versus European government bonds. So those spreads allow you to understand yields. Emerging markets trade at about 400 basis points over treasuries. Now, we will be able to do the same using Ethereum. So XYZ trades X 100 basis points over Ethereum. So therefore, we know there's an incremental risk to that. Now, that risk could be currency risk, i.e. in the token falling, which is what happened in Luna, because the DeFi protocol itself, the smart contract of Anchor, actually continued to pay the dividend, but the currency went to zero. Much like if you invest in a domestic Argentinian government bond, they still continue to pay the coupon, but the coupon's worthless. So that's that example. So there is currency risk, and I'll come on to that in a sec, but there's also other ones that don't have as much currency risk, but which is CeFi, and you're trying to figure out where the yield comes from, because always the yield comes from somewhere, and that yield is risky. So we're going to see, why does one CeFi protocol offer ETH at a higher rate than staking does? Well, some of that is liquidity. So if they're giving you 3 months, well, you're assuming liquidity risk because ETH staking is 1 year. So to have liquidity risk, you should pay a premium for that. So there's different stuff here, and we can explain yields much better and the risk people are taking. The other thing is, how do you think about currency risk? Well, generally speaking, the yield should be adjusted for the volatility of the underlying currency. And if I take a quick ballpark look at Solana yield, which is about 8% versus what we think ETH yields at, let's say, 5%. Now, the difference between those yields actually makes rough sense when you look at the volatility difference between ETH and Solana. Solana is about 30-40% more volatile. So if that's the case, then that's why you're getting a higher yield. Okay, so now we can start creating fair values for yields, currencies, all sorts of stuff here. And that allows us to build better products with better understanding for people what risks they're taking. We can understand when spreads are blowing out, when spreads are narrowing. We don't really get that right now, but we will be able to. And that's going to create a much deeper, more liquid market that attracts more hedge funds, more institutions, more adoption, and more retail who can navigate this space in a better way. It also is going to allow better regulation too, which kind of has to happen after we saw what happened in CeFi. You know, DeFi, that's a different game. CeFi is something that needs regulating because they're pseudo banks. And if they're taking your money and they lose all of your capital, well, you've got a problem with it. And so I think that's going to come as well. And this construct is going to help. So I think this is really important. We're also going to see the rise of guaranteed and structured products around this. Because once you've got a yield on an asset, you can do stuff like take that yield and buy call options, or take that yield and buy puts. It gives you guaranteed funds. That used to be available in the 90s and into the early 2000s in equity markets. We see it in some markets now. So we can create a lot of structured products. Now, as I said, humans are humans. They will create leverage in certain ways, and they will use this to create leverage. But if we can do it in these limited risk ways, like guaranteed funds, okay, that's super interesting. So it's going to make the markets deeper, more liquid. It becomes something much more than it is today. And I can't express how big a demand shock that is going to be over time. We're going to see a wall of money to come in over time and continue that network adoption model as the big money of institutions come in the search for yield and search for exposure to this new technology. That is going to be met by this massive supply shock where so many tokens are locked up staking, and the supply is negative every year, so there's not enough to go around. And that, I think, is a very big deal. And this is why I remain extremely bullish on ETH. I own small amounts of Bitcoin just for kind of nostalgia's sake. ETH is my core position. And I do have some other tokens such as Solana, which I think might outperform even ETH, because I think ETH doesn't provide all the solutions for everything. I'm no ETH maximalist, and different people will take different levels of decentralization. The ETH merge looks like it's happening September the 19th. There are, of course, risks around it. But I think this is one of the single most important things to ever happen in Web3, and it needs to be on your radar screen. I'm not expecting, it doesn't have to be fireworks going into it or the price explodes coming out of it. It may well do. But what I think is it's an accelerant to the space. If the macro's right, then ETH should do extremely well over the next year, 2 years, if the macro cycle remains benign and positive, which is the direction I think it's going. Anyway, good luck out there. I hope this is useful. I think most people don't understand how important this yielding benchmark asset is to the whole world of Web3 and what it can unlock for the future.